evening, everyone, and welcome to the Money Show right here on ET Now. I'm Avan Dabash. Being a Tuesday, this is our tax special, which means over the next half hour, we'll be answering any of your questions or queries related to tax planning. You'll be getting expert advice. So if you have any questions or queries, we have a dial-in number that's going to be flashing on the top and the bottom of your screens. Pick up your phone and dial in. In the meantime, let's bring on board our guest who is with us over the next half an hour. We have Prakash Katodia. He is the partner at BDO, now joining in on the show to talk about planning your taxes, empowering yourself financially and getting to know about all the tax funda so that you can claim your money. Well, let's start off by talking about one of the topics, which is, essentially when people are filing their tax returns, they sometimes, make some mistakes. So they go ahead and have to do a revised income tax return. What really is, the things that they need to keep in mind while doing this, and, what are the consequences of filing a revised return?
Hi, good evening. Generally, when return of income is filed, and if any mistake was there in return, which is realized afterwards, then there is an option available to revise the return. Earlier, there was a provision that if return is filed late, then it cannot be revised, but now return can be revised. But simultaneously, the time limit for revising return has been reduced. So, for year ended March 18, if return is to be revised, then either it has to be revised before 31st March 19 or before the assessment is completed, whichever is earlier. So, even if return is filed now before 31st August and before 31st March, if any mistake is realized, then person can always revise his return.
So, what are the consequences of filing a revised return then?
If revised return is filed, then revised return will override the original return. So, assessment etc. will happen on the basis of revised return only. But if return is selected for scrutiny, then there are chances that tax officer may inquire reason for revising the return. But there need not worry. If it's a genuine error, then it can be always explained.
Okay, fair enough. So that is what you need to keep in mind while filing your returns. In case you're doing a revised returns, do make sure that there are not significant changes, because as said by Mr. Katodia, this could attract attention of the tax authorities. Well, we have a whole host of tax related questions and queries for you as well, and do remember that if you are watching and if you have any questions, there's a number that's flashing on your screens. Please do dial in and we will connect you live. Well, we have Sharmili Gupta who sent us this question. She asks, my brother sold a house that he inherited from our father and gave me 10 lakh rupees from the sale proceeds. Am I liable to pay any tax amount on this, and under which section should I report this income in my income tax returns? So she doesn't really own the flat from what we understand, Mr. Katodia, but what do you think are the tax implications? Are there any, or is it her brother who is liable?
Yeah. Prima facie, although your interpretation is correct that she doesn't seems to be owning the house,
right.
But if it is inherited from father and if both are owning it jointly, then in that case on the sale proceed, both will have to pay the capital gain tax. But if it is not like that and it is singly owned by your brother, then in that case he will have to pay capital gain tax on the house which is sold. For the purpose of paying capital gain tax, cost of acquisition will be cost of acquisition of your father, as well as holding period will be counted since the date when your father has acquired the house. Coming back to money which your brother has given to you, if it has nothing to do with your owning of house, then it will be considered as a gift given by your brother to you, and it falls within the definition of relative. So there will not be any tax liability on you. But other way around, if you are owning the house jointly with your brother, then in that case on your share of money, you will have to pay the capital gain tax.
Okay, so I think what's been understood from this is that it's largely contingent on who the owner is of the flat is. Are you jointly owning it along with your brother? Is it just your brother? Then based on that, the tax implications will be applicable. I hope we were able to answer your questions. And as I said, we have Mr. Prakash Katoria, partner BDO, with us over the next half hour on the show. So if you have any tax-related questions on queries, you want to know your fundas, you want to know how to claim taxes, well, please feel free to dial in. There's a number that is flashing at the top of your screen. So simply email us. themoneyshow@etnow.tv is where you can reach out. Well, Madhav Shah has sent us a question now. He says, I bought a life stage pension advantage policy from ICICI Pru Life Insurance. This was converted into a paid-up policy after paying 5 consecutive annual premiums. So what is going to be the tax implications when I surrender it? So could you just explain to us what exactly this policy is and what exactly are the tax implications for him, under which section? He's asking because he's surrendered this policy after having paid the annual premiums.
Yeah, this policy is probably in the nature of ULIP link insurance plan. So I believe that whenever you have paid a premium, you would have claimed that as a deduction under section 80C. As per section 80C, if any policy is surrendered prior to maturity, but if premium has been paid continuously for 5 years, then in that case there are no consequences, and whatever deduction you have claimed, you will continue to enjoy that. If it is surrendered prior to 5 years, then whatever deduction you have claimed earlier, that will be withdrawn. In your case, you have clearly stated that you have paid premium for 5 years, so it appears that you will not be taxed for the deduction you have claimed in the earlier year. So far as surrender value is concerned, since you are withdrawing it prior to maturity, so surrender value will be liable to tax in your hand.
All right, I hope you've taken note. That's the advice coming in with respect to the deductions that can be claimed and the premiums as well that would be added to your income and tax. This we're talking about the life stage pension advantage policy from ICICI Pru Life Insurance. Well, we have a live caller connecting with us, so let's get straight to it. Sandeep Anand is with us and he's connecting with us from New Delhi. So let's understand his question. Hi there, Sandeep. Welcome to the Money Show. This is our tax special. Good evening. What's your query?
Yeah, good evening. Thanks for taking my call. So I have the salary income which is less than 50 lakhs, but if I include the income from mutual funds and other sources which are not taxable, so exempt income, it goes above 50 lakhs. So okay. Should I file ITR 1 or ITR 2? And I have to fill in all the details about assets and liabilities that. So can you help me with that?
All right, Sandeep, thanks for that question. Going to take it across to you, Mr. Katoria. Very categorical that it is only the income that he is gaining, that he is earning from items that are not taxed like mutual funds, etc. So what is the ITR that he should file? 1 or 2?
Yeah. So ITR 1 is applicable when your taxable income is less than 50 lakh. So whatever your mutual fund etc. exempt incomes are there, that need not be counted for computing the taxable income. So you will be certainly eligible to file ITR 1 subject to other conditions satisfying, like there should be only one house property if it is there, and income from other sources and no capital gain tax etc.
I hope we were able to answer your question, Sandeep. Thanks for connecting with us. We have another caller then. Bhupen is with us. I believe he's got a question. He's from Hyderabad. So let's understand what his query is. Bhupen, hi there. Welcome to the show. What's your question for us?
Hello.
Yes, Bhupen, we can hear you. Good evening. What is your tax-related query?
My query is, I am a salaried employee and my query is related to the HRA.
What is the question?
Right. I own I have a rented house here. My parents are paying rented house in Mumbai also, and I have a flat owned in Ahmedabad. So how do I save the tax when it comes to HRA? I know that there are certain limits. So How can I
Mr.
save
Katodia, are
HRA?
there any counter questions that you would like to ask him or like to understand a little bit more about these properties?
Yeah. I think correct me if I am wrong, you are staying presently in Hyderabad due to your employment and you are owning house in Ahmedabad, correct? That's what you are
Yes,
saying?
and my parents are also staying in Mumbai on rents.
Okay,
So,
so
I mean,
two
I
rented
have a
houses in
salary.
Hyderabad and Mumbai, and the owned apartment is in Ahmedabad.
Okay. So, for computing your HRA exemption, there is no need to look at your parents' rented house or your own house. You will be entitled to claim HRA deduction subject to limits which are prescribed under section 1013 about 50% of salary and excess of rent paid over 10% of salary and actual HRA received, whichever is a lower amount, you will get deduction for the same.
Bhupen, was that clear to you?
Yes, definitely.
Thanks so much, Bhupen, for connecting with us. And for all of those who are watching, if we can't take your calls right now, we have an email ID. That's themoneyshow@etnow.tv. Every Tuesday, we take up tax-related questions. If you have any queries that are long, lengthy, you don't want to explain it on the phone, please email us. In the meantime, our phone lines are going quite berserk, Mr. Katodia. Lots of questions coming in for you. We have another live caller, Ravindra Saxena. He's with us from Bhopal. Welcome to the show, Mr. Saxena. What's your question?
Yeah, thank you very much for taking my query. I have got two questions related to my investment in stock market. My first query is, if my dividend receipt is more than rupees 10 lakh, how it will be judged under the income tax? Okay. And my second query is, I am doing a lot of margin trading. So I am paying interest on the funds borrowed from the bank, and paying some securities transaction tax and SCRA. So how is it deductible under income tax assessment or not? Thank you.
All right, thanks for your question. And he's essentially asking about this dividend of over 10 lakhs and this margin trading. He's already paying the interest on the funds that are borrowed plus STT. Is this applicable? What is the best tax saving advice?
Yeah, so first we will answer your first question about dividend tax. So, if your dividend income is more than 10 lakh rupees, then you will be liable to pay 10% tax on that. Coming back to your second question, for that we have to see that are you categorized as engaged in the business of share trading. If you are engaged in the business, then interest, etc., all expenditure you will get deduction against the profit liable to tax. But if you are not engaged in the business and you are claiming this as your investment activity, then in that case, it will be liable to tax as capital gain, and against that no interest deduction will be available.
Okay, and that is making it clear as to what you should do with respect to your investments as well as your margin trading and how you can look to save tax. I think our next caller is Dr. Jill from New Delhi, if I'm not mistaken. So let's connect right to him. Thank you for being with us on the Money Show. Tell us what's your tax-related question.
Thanks for taking my query. I had filed my income tax in almost June, and there was some refund which I was to be given. How long one has to wait to get the refund?
Okay. Would you be able to answer that question?
Yeah. Generally now income tax department is processing refund cases very fast. I can say in a couple of months. So if you have filed return in the month of June, presently we are in the last week of August. Ideally, maybe you should get your refund in next 1 or 2 months.
Okay, thank you. Thank you.
Thanks for connecting with us, and let's take a... Welcome back. This is the tax special on the Money Show, and we have Prakash Katodia, partner BDO, who is with us answering your questions and queries and talking about very relevant topics when it comes to empowering yourself financially and knowing the tax saving fundas. So, you know, we discussed the revised tax return form that you have to send, the income tax form. But let's get down to basics, Mr. Katodia, and talk about the process of e-filing. If someone is looking to do that, you know, everyone says adhere to the date. How exactly, what is the process for going about it? What are the implications if they do not file their income tax returns on time? And what are the precautions that they need to take and keep in mind?
Yeah. So, presently the due date for filing income tax return is 31st August for certain category of taxpayer, which was originally 31st July. but extended to 31st August. This is the first year when for not filing return in time, there is a provision for payment of a penalty which is in the nature of fees. Those who have an income less than 5 lakh rupees, and if they do not file return in time, then they will be required to pay penalty of 1000 rupees. And for others who have an income above 5 lakh rupees, they have to pay penalty of rupees 5000 if they file till 31st of December, and if file after 31st December but before 31st March, then the penalty will be 10,000 rupees. So ideally it is advisable that we file our income tax return before 31st August and do not unnecessarily pay penalty.
Okay, so that is what you need to keep in mind in terms of the late fees or the fine if you are not on time. But what are the precautions that you need to take while filing an income tax return?
Yeah. One more thing also isolate, that if you are filing a return late, then apart from the penalty, there are other consequences also. Like if you have a losses under any head of income other than house property, then that losses lapse. You cannot carry forward those losses. Okay. Apart from that, there will be interest payable also for late filing of return on whatever tax is payable. So apart from penalty, other consequences are also there. So ideally we should file in time. Coming back to filing a return, it's very easy, and online filing of returns are possible. There are various ITR prescribed for various category. ITR 1 is for people who are having a salary income, income from only one house property and a capital gain. They can choose ITR 1 to file. ITR 2 is there where it is applicable to individual and HUF where they are carrying on some business. ITR 3 is there where the condition of ITR 1 is not satisfied, but still they are not carrying on business, then they can file that. And ITR 4 is there for a presumptive taxation. ITR 1 and ITR 4 can be filed online. So straight away from the income tax website, you can fill in the form and upload the return. If you don't choose to file online and if you choose to file offline, then in that case utility is available on the income tax portal, which you can download the utility, you can fill in the form, and then that utility is in Java, which can be converted into XML, and then the step-by-step process is given in the on the website, which you have to follow, and then attach the Excel utility into the return. So return can be filed. The another important point is there that with ITR, no documents are to be attached. Only ITR form is to be uploaded.
All right. So clearly simplifying the process, talking about what you need to keep in mind as well as the implications if you don't file your income tax returns on time. Well, we have another query from Hema Bhandari, and she asks, can a Hindu undivided family or HUF claim deduction under section 80C for contribution made to PPF account of any of its members?
Yeah, HUF will be eligible to claim deduction under section 80C for contribution made to any member's account.
Okay. All right. I just wanted to clarify on this that the contribution towards public provident fund and HUF, I believe, I don't know, I'm not sure, cannot open a PPF account in their own name. But yeah, you said under section 80C, right? Yeah.
Because the question was that whether in members PPF account she can deposit or no.
Okay.
So she can always deposit. Now HUF cannot have its own PPF account.
Understood. I hope we were able to answer your question. Let's take on board the next query. And as I said, our phone lines are open for a little more time. If you have any tax related questions or queries, pick up the phone and dial in. There's a number that's flashing at the top and the bottom of your screens. Neetu has connected with us. She says, after working for 20 years, I lost my MNC job in mid FY 17-18. I had contributed to an EPF for over 10 years. Will the interest earned after the date of termination be taxable? And will the balance continue to earn the interest till I reach the age of 60? Is ex gratia and notice period payment eligible for tax exemption and termination? So essentially, I think this is a valid question because a lot of people would have filed all of the valid returns while they were with the company, and now given that after 20 years she's lost her job, what are all of these, the tax implications?
Yeah, so this question need to bifurcate it in three pieces.
Sure.
So I believe first point is there that what will happen to your PF account. So since you don't have a job, so your contribution to PF account will stop. Up till now, it was allowed to continue that account for 36 months, only 3 years. But recently there is an amendment that if due to unemployment, you are not able to contribute to PF account, then that PF account can continue. So that answers your first question. Second was about the interest, accrued interest on that. So once your PF contribution is stopped, then that interest will become liable to tax in your hand. Up till now, there were some ambiguity about that was there, but a couple of months back, there was one tribunal decision which has clarified that interest will be liable to tax. So accrual of interest on PF account when you are not on job will be liable to tax. And certainly notice period and ex gratia payment what you will receive, that also will be liable to tax.
I hope we were able to answer your question, Neetu, because it was a little bit complex, but we had Mr. Katodia break it down for you in order to understand the tax implications. On that note, we're completely out of time, Mr. Katodia. Thank you so much for joining in and helping out all of our viewers with their tax-related questions, as well as giving us lots of pointers and notes to keep in mind while filing tax returns. We'll wrap it up next Tuesday. We'll be right back with the tax special on the Money Show. With that, it's a wrap.